Hello everyone, and welcome to another Facebook Live session here with Stashaway. It's Freddie Lim again, our Chief Investment Officer, and I'm Philip. I'm heading the partnerships function here at Stashaway. And the news has been talking about, and I think a lot of people actually have questions on. So first of all, I think we will start about the recent MAS tightening policy and how does it affect actually the USD SGD exchange rate. And then we'll talk a little bit about the US dollar in general, kind of outlook, overview worldwide with current news items on the agenda. We'll give you a quick update on the trade war. And also we'll touch on the correction that we're experiencing. Is it kind of over now, or is it still going on? Does it maybe even have another leg down? We don't know, but let's talk about it. And what does it actually all mean? In the end, we'll try to wrap it up and say, what does it mean for you as an investor? So Freddie, with that said, I think maybe we'll start with the current MAS tightening that for the first time in 6 years, I think, that it happened.
Well, if you take a step back, you would realize that in Singapore, we don't have an interest rate policy. So we manage the economy through an FX sort of policy. And so the Sing dollars is in a way managed against the US dollars. So when the US dollar, say when you have interest rate hikes in the US right now, in Singapore, interest rate will tend to follow what's happening in the US. So without even tightening monetary policy, the MAS has already tightened because interest rates follow the US, and the US we had 3 rate hikes last year. So the decision for MAS, when they go beyond that and say they want the currency to appreciate, is a tightening that's in addition to what is already been done in the US. So it's got to be from the inflation angle, not from the growth angle. Mind you, the MAS in this round did say that they want to appreciate very slightly. And so it's more of a response to what's happening in the potential trade tariff situation where imports could be more expensive. So that's more like a protectionist measure against higher inflation. Strengthening the Sing means you import things cheaper going forward. However, interestingly, the dollar Sing has not fallen further since the announcement, which means it has been fully priced in by the markets. Nothing to worry about. The market has not moved since the announcements.
Okay, thanks for the update on that. And again, I'm seeing some questions come in. We'll definitely will be addressing them throughout the Facebook Live that we're on right now. Just give us a few minutes. We'll cover a couple more topics, and then we'll get to anyone's questions. So with now kind of knowing more background on how the MAS and why they actually did all these things, right? We come back to like the whole trade thing, and before we go more deeper into like updates on, every week there's a new update whenever Trump tweets, right? So what does that mean all in terms of the US dollar compared to other currencies, just worldwide in general, and not just Sing dollars, right? Because we're all investors in global markets, so I think it's important to look at also outside of Singapore.
Right. From between January to now, you know that the US dollar has gone down further by about 2%. A part of the reason is that there's a fear that we'll go back to the 1980s trade war scenario between US and Japan and spiral out of control. So in principle, if the world is more protectionist in nature, the US dollar would tend to go down with it because it's the reserve currencies, right? It's the major currencies that everybody trade with. When protectionism is on the rise, there will be lesser trade, lesser use of the US dollar. So in theory, the US dollar will depreciate in a high trade war situation. So that was the fear from before. However, interestingly, majority of the US dollar depreciation actually happens at the end of Jan and early Feb. Since then, it's just been flatlined. The market hasn't reacted further to the jawboning by Trump. Trump's been tweeting all the time, trying to talk it down. The market just simply hasn't reacted further. So I just by the data, we are kind of at a resistance point where the market is very comfortable, it's fully absorbed the information, a lot of it has been priced in, stability is coming to the markets.
And I think people just don't know that if you don't watch the market all every day, right? Because from a news standpoint, you still think it's all over the place, right? So I think that's a good point to make. Just like it's actually not been that bad since the original down, right, in the market.
Let's not forget, two more important things are happening. The U.S. Federal Reserve is a major central bank in the world and the only one leading the charge in hiking interest rates. Higher interest rates means US dollar goes up in relation to other currency. Hasn't happened, so the opportunity. Two, some of you may not be aware, there's something called LIBOR-OIS spread. LIBOR-OIS spread is going up, and it tends to go up when there's a lot of funding pressure, credit is not very easily available in the banking systems, and that's been squeezing a lot of the borrowers. That rate goes up, tend to go in favor of the US dollars. So they are interest rate perspective that argues against the weakening of the dollars. It hasn't happened yet, but we have stability right now. This is an opportunity to wait into the markets.
Okay, good. And then I think with that being said, can we then for sure say that the correction is kind of a thing of the past now already, or do you feel like there's not enough information yet that that we're just on the way over to get back to making new highs, so meaning the correction being over?
I think actually Philip does some homework on that. On average, past corrections that we have analyzed lasted about 4 months, meaning it takes about 4 months on average to recover. We're now about 3 months into the correction. Of course, the trade war has certainly, sorry, not trade war, the trade spats. It's not a trade war yet. It hasn't started. We're in the 60-day cooling period. Yeah. No tariffs been imposed yet from the US.
Not a lot of people know that, right?
Yeah, they don't know that.
It's already happening.
Exactly. It's just talking right now. But the trade spats has been going on. Yeah. And it has certainly interfered with the speed of the recovery from the correction. But again, a correction always happens as long as the fundamentals are strong, and they are very strong. US industrial production further accelerated over the last 2 months. Leading indices around the world, published by the Conference Board on China, on major economies, on the US, further accelerated. As long as the fundamentals are strong, a correction will be over. But the speed has been made less certain because of the trade spats that we have right now.
Yeah, I think again, so what you just said, it's they take from 4 to 5, 6 months to play out, right? Mm-hmm. And I think just to underline again for investors, right? You should be doing your monthly standing strategy. You shouldn't be stopping and doing corrections, because that's when you get things much cheaper than usual, right? And I think that going in another direction with that is actually we had a question from Andy, and he asked, should I wait to invest with all the market corrections going on, or does it really matter at all? Maybe, from what I just said, but maybe you can emphasize on this again, what should be the strategy for, like, say, Andy, one of the people who would like to invest or is invested at the market?
I think I will answer the question in the later part, but let's step back a little about, again, let's emphasize the difference of a correction versus a bear market. A correction doesn't change anything. It's a sudden, rapid, intense, emotional reaction of the markets. But don't forget, correction always happens when there's bad behavior. As we know, there's a lot of fear of missing out, there's a lot of complacencies prior to the corrections. So correction is a way that the market detox, so that it cleans up the bad behavior, so that it can move forward healthier. A correction is never the beginning of a bear market. A bear market always starts with a whisper. You don't even know it until it's too late. And a bear market will take a lot of time to evolve. So I would like to emphasize the difference between the two. What we have here is a correction. It's not a bear market because the economy is doing well. The leading indices are even better than before, right? So the corrections are actually an opportunity for the long-term investors. As long as you have a commitment to your long-term plan, right? It's goal-specific, goal-based investing. You commit to a plan, you contribute monthly, you're averaging into the markets at cheaper level. We couldn't invest in growth like last year, right? It was always overvalued last year, but the fundamentals have further improved, and now we're afraid? Not at all. This is a situation where you should be even more committed to your plans. And because you're getting better bang for the buck by being in the market now, right? So that will be my opinion.
Yeah, so a lot less than obviously at the end of Jan when we reach the latest new highs, right? So with that, is there any other questions that we can see so far? No, so no questions at the moment, but I think we can maybe wrap it up for today. And if you do have any questions later on, you see this as a recording down the line, maybe even tonight or over the weekends, please feel free to still ask your questions in the comment box below, because then we can have our support team get back to you, or even have another session and address them at that point. So again, thank you very much for listening today or over the weekend when you watch the recording. Have a great weekend. Yeah, exactly. And we'll see you shortly.